Daniel Needham, you're President and Chief Investment Officer at Morningstar. Markets reacted very positive after the Fed monetary policy statement. Why was that?
Well, I think that many people have been expecting interest rate increases from the Federal Reserve, and I think that there was a little bit more of a, let's call it a dovish tone, and so effectively that meant that the market prices adjusted for maybe a delay in an increase in interest rates, and that affected many asset classes. So effectively, when interest rates are expected to rise, the present value of future cash flows is lower, and so if there's any adjustment to that, it affects markets. I think the US dollar has obviously been a primary vehicle for people expressing their view about monetary policy. So when the US has been on a tightening bias, that's meant the US dollar has been strong, and with the euro being on a weakening bias, that meant the euro has been weaker. And so with that announcement, we saw a shifting of positions within currency markets.
Is the US already ready for an interest rate rising? I mean, the inflation are pretty low, exports are sliding. What do you think?
It's a difficult question. The global economy is in a very challenging situation. So a lot of the recovery that we've seen within the United States, within the United Kingdom, has been supported with significant fiscal and monetary policy. And we had a kind of arguably a once in a 50-year or maybe once in a century type of deflationary pulse that hit markets in 2008, hit the economy and markets. And so that required pretty extreme policy measures. And the question is, when can you take some of those extreme policy measures away? I'm sure that the central banks would prefer that a wage inflation or wage growth would be much more robust than it is now. And so I think that they're more likely to leave interest rates lower than they would if we saw the increased economic activity flowing through into wages. And so that's really the key, I think, key economic sort of item that they're watching.
If you had to bet, what do you think? Will it be this year?
I mean, I think it's likely that we'll see an interest rate increase in 2015. However, I think the central banks are very data-driven, so we've got some countervailing forces from the weaker oil price that's affecting the US economy. I mean, it's been very clear in the kind of, let's say, oil importing countries that there's been a surge in demand as people have more disposable income because the price of oil is lower and therefore the price of petrol or gas is lower. So that's been a positive force. The US economy has benefited significantly from the shale oil investment, so fracking. So there's been a significant increase in capital expenditure in the United States over the last 2 years. So that's actually starting to slow now, as many of the exploration companies are kind of stopping their spending, and oil services, mining services companies are actually seeing the demand for their goods decline. That's actually a slowing effect on the US economy. So I actually think there's potentially a couple of countervailing forces that mean that the US economy could be weaker in the back of the year, which may mean that the policy tightening may not be necessary.
Many indices are on record levels. For example, the US market gained more than 200% over the past 6 years. How possible is a crash in combination with the rising interest rates?
I mean, it's very difficult to predict market crashes, or to be honest, it's very difficult to predict any kind of short-term market movement. I guess one of the preconditions of a crash is normally high valuation. So the price of companies trading at a high level relative to the intrinsic value or the cash flows that they generate. I think that's actually in place now in the United States. I think US equities are very overpriced. I think it's difficult to work out exactly what companies are worth when interest rates are so low, because central banks are keeping interest rates very low. And so the question is, how long will that be the case? If interest rates stay low for 20 years, arguably companies are probably worth more. And the question as well is, how much has the government policy influenced the profits that companies have been able to generate? It's very difficult questions to answer, so it requires a lot of judgment, which means that there's a lot of uncertainty in the outcome. But I certainly think that equity prices are significantly up their previous lows, and cash flows or profits look high relative to history. So the question is, I would say that the downside risk of equities more generally is probably higher than what we've seen, certainly from the 2009 lows, but it's difficult to predict.
Do you see alternatives to equities?
There's many other things to invest in other than equities. So there's obviously property, so listed real estate. You have direct property, direct infrastructure. You can invest in corporate bonds and government bonds and foreign currencies and things like that. I think that what I would say is that many asset prices have been influenced by this extreme monetary policy. So when interest rates are low, any cash flow generating asset can be bid up such that it kind of drives the valuations of all assets up. So it's a very difficult environment to find let's say, attractive investments. So you need to take a long-term view. You probably need to be prepared for greater volatility. And I think it does make sense to be more diversified. I think for investors that are very exposed to US equities, I think it probably makes sense to reduce their exposure. However, currencies are an important question. So when interest rates are fixed at zero, currencies become one of the key monetary policy tools. And so which currency you're investing in actually matters in this environment, and currency volatility has picked up.
You mentioned the long-term view for investors. What are big challenges on the long and midterm?
I think the challenge in the long term is to kind of defeat the forces of human behaviour, and that is, to stick to a long-term investment plan and not to be swayed into the short-term gyrations of the markets. I think when investors go from being prepared to deal with the future to trying to predict it and trying to time it, that's when I think many people make mistakes. So I think having a long-term view is quite important, and being willing to sort of ride out market volatility. I do think that generally being counter-cyclical is actually the biggest challenge for investors. So when the markets are up, everybody feels like they want to own more. And when the markets are down, they feel like they want to own less. And in actual fact, you want to do the opposite. When markets are up, you probably want to own less. And when markets are heavily down, it probably makes sense to own more. And so being a valuation-driven investor is quite important. And we think taking a long-term view and being willing to stand against the trend when things become extreme is key.
Daniel Needham, thank you very much.